This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, Bank of America's shocking claim defies all expectations. And I want you to see why that if this comes true, that markets will outright panic. Plus, Citibank is back in the news as their CEO is faced with doing the unthinkable. And we have two major economies that are showing further signs of being on the verge of outright collapse. And if you're wondering what we're doing in South Korea today, well, we have new evidence that says that their stock market might be about to crash. And with that, let's head over to CNBC, where we picked today's story up with a headline: Citigroup considers deep job cuts for CEO Jane Fraser's overhaul called Project Bora Bora, should be called Project Pink Slip, as the only thing she can do at this point is really a substantial headcount reduction. And of course, she needs to do something big. And I think there's a good chance it'll be bigger and more painful for Citi employees than they expect. And the whole basis for this piece is the understanding that Citibank is struggling financially. That's why we talked about last week that they're going to probably cut off mailing credit card bills. And it seems so simple. That can't be a big deal, but when your company is struggling, anything to save a penny matters. And the reason we're talking about Citibank is because in the coming quarters, we're going to find out that many of these companies, particularly major companies, are going to see revenue declines, profit declines, and they're going to be pushing to get their numbers up. And as you're about to see, because the holiday season is not going to pan out the way we want it to and way everyone's hoping to. And as a result, your many companies are going to make the tough decision to lay people off. And that's something that nobody is expecting to happen, particularly the political elites. As the holiday spending outlook is now sluggish across thousands of retailers. And of course, this is a huge shock because we've heard about how robust the labor market here in the U.S. is, and that consumers are eager to go out and spend. We know that wholesalers have bought up inventory, retailers have bought up inventory, and everybody is eagerly waiting for American consumers to come out and do what they do best. But now we're seeing signs, just as we predicted, that when you see financial conditions tighten, when you see banks constrict credit growth and limit the amount of credit people have, well, what happens is all of a sudden demand comes plummeting down on the back of the fact that we know that wages for many Americans are not keeping up with inflation at all. And all that tells us is the holiday season's going to be ugly. As holiday shopping begins, a lack of big orders from retailers is the rule amid fears that consumer spending will be weak. And we've been making this claim because what have we been looking at around the world? We've seen new order demand decline. And even worse, we've seen backlogs of orders also shrink, telling us that the demand for labor here is going to be a problem, particularly if there's not a major pickup in demand. And here we're seeing it right now from this recent survey that demand is nowhere enough to drive orders. And here we can see the largest retailers are past working through their excess inventories. I don't think that's true at all, but careful not to over-order. And while some of the small to medium-sized retailers are still destocking, in fact, we can note that retail inventories are well near their all-time high. The notion that they're destocking here at all is a myth. They've got a massive amount of old inventory that needs to be cleared. But the problem here always comes back to the lack of new order growth, because we know what that means. It eventually says that it's not just Citigroup that's going to be laying off, it's going to be everyone. And sure enough, the evidence here is that we look at the current new orders diffusion indexes for the Philly Fed manufacturing sector. And what do we see overlaid in red is the 4-week moving average of initial claims. And sure enough, when new orders decline, what happens is employers need fewer workers. And we see that here in the 70s, going into the 80s again, in the early 80s, that double dip recession. How about the 90s? You've got it. Early 90s, the same effect happens. Dot-com bubble, global financial crisis. Now, if you wonder why new claims came down, it's because we saw a pickup in new order growth here in the U.S., but now we're seeing from the early survey data telling us that new order demand is not only coming down, but backlogs are about gone, and that tells us that at some point we're going to start to see a pickup in initial claims. That will drive the 4-week moving average higher, and it's not going to be just a U.S. phenomenon. It's going to be a global one for sure. And here we see C.H. Robinson's economic team believes the economy is approaching an inflection point. Well, we're probably there already in consumer spending because we don't have real-time data as Americans deplete their savings they built up from the pandemic stimulus. And that's something we've noted is a huge issue here, that the global economy has been fueled by massive amounts of U.S. government borrowing and handouts to U.S. consumers who have been buying on credit, been buying everything from goods to services. They're out of that money, and that is a huge game changer here for not just the U.S. economy, but the entire world, as we're already seeing this emerge in some leading indicators like loan and credit card delinquencies. And remember, we've talked about this before. When banks constrict credit and the creation of new money into the economy, the problem you run into is you need enough new money growth not new money created to spur growth and maintain it, but also to pay on the existing debts. So when you start to see a rise in delinquencies, it usually comes right along the same time banks are constricting credit, and that bodes bad news for the retail sector, because what we want to see is consumers current on their payments and with plenty of limits on their credit cards, because we want them to go out and charge the holidays like they usually do. This time, there's no margin for error. Here we can see the delinquency rate on credit cards for all commercial banks is shown in blue against advanced retail sales. This in red, both on a year-over-year rate of change. Here's what I want to see is when delinquency rate on credit cards surges into the positive, what happens? Retail sales growth declines. You can see it here go into the early 2000s. You see it again in the dot-com bubble or the global financial crisis. Let me restate that. You see delinquency rate rising. Of course, retail sales comes plummeting down. We haven't seen it yet because of the pandemic stimulus, but imagine here in a month or two, we should see what we expect. What retailers are kind of telling us now is that there is going to be a severe lack of demand. Retail sales are going to come down, and that means we know that retailers, wholesalers, and manufacturers all will have no choice but to follow Citigroup and lay employees off. And with a lot of uncertainty around consumer demand, interest rates, in the global economy, most people do not have a positive outlook on freight volumes. Again, we touched on what's going on with Maersk last week, who was laying off 10,000 people. Again, you're seeing this global trend that everything is slowing down. Global trade is a wonderful leading indicator. They're laying off people. That means if Americans don't come out and spend, there's going to be mass layoffs into early next year. And sure enough, we could certainly see a rebound in the second half of next year. That's putting things pretty far out in terms of when we could see a rebound. Yet importers and exporters should take note when thinking about long-term contracts versus leveraging the spot market when planning transportation budgets between now and the negotiating season early next year, because if demand doesn't return, of course, we know shipping rates are going to outright decline even further than they are now, setting the stage for a deflationary environment at a time when global central bankers only have one thing on their mind, and that's inflation. But meanwhile, we see two major economies on the verge of further collapse as the UK is likely in a recession. Well, make the case they are in a recession right now. As modeling shows, there's a 52% chance of a mild recession in the second half. I like the notion here because everything we see says mild recession, soft landing, there's going to be a rebound, and not everyone is convinced. But one thing that should not be in a recession right now is your trading account. Let's do an update on our trade that we featured on Sunday's show on the S&P 500. Here you can see from our November 3rd report, we see the SPY or S&P 500 came off that max short position at minus 100 and minus 100 respectively on our fast and slow algorithms. Now what you're looking at is our report that mimics machine positioning. It usually gives us a lead on what everyone else is doing. We tell our subscribers, we give them updates a couple times a week. We say, watch these. When it reverse, that's when you need to look to take a trade. And on a pair combo with this, with our Momentum Timer Pro report, it looks at technical analysis signals and takes all of those things that people look at and smooths them all out into one simple report. Gave you a one daily buy signal, and that's what we look at when our most successful traders that have both reports, they wait for confirmation on the technical side and the machine positioning side. When they do, they take a trade and put a stop loss underneath it, and sure enough, that means a buy it open on Friday. At the time of recording, that trade would be up 0.55%. Now, if you remember what we talked about on Sunday, the upside potential from the machine positioning, corporate share buybacks suggests that there's a lot of upside in that trade, and you too can follow along, be a member of both reports. And right now, I put a few more coupon codes, 5 up for each of them. You can get a free month if you're one of those lucky 5. Links in the description below. Check it out, because it'll be a close call between stagnation and mild contraction. My friends, there is no such thing as a close call between stagnation and contraction. It's because stagnation leads to contraction. I'll show you that case. It happens every time, but the odds are tilted marginally in favor of the latter. Well, the odds are tilted far more than that, as you're about to see, because the risks are that the fall in output is a little sharper than we had penciled in. Of course, no central banker or political elite thinks it's even possible, even remotely possible, that the global economy could enter a massive recession. No one believes it, and yet when it happens, they're all going to be dumbfounded. And here we can see the consumer price index for consumers shown in blue against the 4-week moving average of initial claims, that in red. And of course, the CPI, that is on a year-over-year rate of change. You want to see stagnation? Well, that's when you see rising unemployment claims and rising inflation. Well, you do get brief periods of that, but guess what? When people go on unemployment, as you can see here, the red line rising, those initial claims surge higher. What happens, even with a bit of a lag, inflation comes crumbling down. You see that in the 70s, even in 75, during those periods of high inflation. You know, the Fed is worried about this because they think the labor market here in the U.S. cannot be broken. We're putting up the data, showing you the evidence. It's on the verge of that. And yet what they don't understand is if the U.S. labor market goes, and we're seeing all the signs of it, inflation goes with it and likely is turning into deflation. Here you can see in the 80s, a double dip recession. We see surging claims on both sides, leads to an outright collapse in the consumer price index. You've got it in the 90s. You got it in the dot-com bubble. How about the global financial crisis? There too. And look now, and look how much inflation came down on just a small rise in initial claims. Imagine this gets out of control. And of course, that just adds the narrative of what Bank of America had to say today. And wait till you see it, because their claim is so shocking that it's hard to believe. And again, we've talked about markets panicking. We talk about central banks panicking. Well, wait till you see what they had to say, because let's put some further evidence that panic's going to be in the UK as well. And notably, UK construction material costs slid at the fastest pace, get this, in 14 years, as a slump in home building drives a drop in activity. With what shocking amazement we see that S&P Global's construction purchasing managers index edged up to 45.6 in October from 45 the previous month. Just keep in mind, anytime you see a number below 50, it means it's contracting. The further below 50, the deeper the contraction. Above 50, it's expansion. At 50, virtually unchanged from the month before. So here we see a second month here in contraction, and October's reading was the second worst since the first COVID lockdown. Remember, we already know the economy is headed into recession then. However, the sector's slump, which has been triggered by retrenchment in home building, helped ease cost and supply chain pressures, suggesting when demand goes down, as we've made the case, demand goes down, price pressures fall. Sure enough, that's what we're seeing here in the UK housing sector. Meanwhile, input prices fell at the sharpest pace since 2009, reflecting weaker demand for construction materials. Think about that. We were in the midst of a global financial crisis. These rates charged by some contractors slipped for the first time since July of 2020. Meanwhile, the survey suggests that a struggling economy has helped dampen inflation. There's the case that we've been making the whole time, that really inflation, while it does measure prices, it also measures supply and demand. You see demand coming down, inflation falls. It all makes perfect sense. The problem is nobody believes that demand in the U.S. is coming down, and yet the evidence continues to suggest that U.S. consumers are tapped out, and we're going to find out during the holiday season just how bad things are. And here we can see suppliers are forced to be more competitive amid lackluster demand. When that happens, price falls. And the construction sector is particularly hard hit by high interest rates and has suffered a sharp increase in insolvencies. Again, there's that evidence that we're running out of money because banks are tightening lending standards, because central bankers around the world have inverted yield curves and money curves because they're absolutely clueless how our monetary system works. It's only a matter of time before they drive us into an outright financial crisis, and you're going to watch banks around the world come crumbling to their knees. The drop in optimism may not be surprising given there have been a number of high-profile insolvencies across the sectors in recent months. Hey, it sounds a lot like China to me, and this can significantly impact developers who need to find alternative contractors to complete projects normally at substantially higher costs than envisioned in the original design and procurement phase. Nonetheless, they'll probably be eager to have the business. At some point, we'll see price pressures come down, but it's not just the UK. We've been talking about Germany, and now look at this headline. Look at the optimism here, but really underneath, there's major problems in the German economy. As German factory orders unexpectedly edged higher in September, we see demand rising. A 0.2% increase in demand represents the second straight monthly gain, and that must mean things are going well. But of course, it doesn't, because August advance, however, was revised down by about half to 1.9%. The agency said September's result came into thanks to 4.2% in jump in foreign orders that offset a 5.9% slump at home. So you can see internally, the German economy is in a recession. They're in denial because we know it's probably actually in a depression. They just don't want to see it. Over the third quarter as a whole, there was a decline of 3.9%. Meanwhile, a survey of purchasing managers published last month showed production across the manufacturing sector remained under pressure from a sustained downturn in new orders. The weakness is weighing on the entire Eurozone. Of course, again, we make the continued case, and that's why we get to what B of A is talking about here, why markets are going to be panicking, because what do we continue to see? New orders declining. Everywhere we look, yes, we get little pockets of improvement and everybody gets excited. The reality is new order decline leads to more unemployment. It is not a U.S. thing. It's not a German thing. It is a definitive point of how our monetary system works. And if there's any more evidence you need the German economy is as bad as I'm claiming, take a look at this. As German housing cancellations hit record as crisis deepens, nearly half of home builders complain of a lack, here we go, of new orders. And you know what that means, of course, unemployment claims going to head higher in Germany. In October, 22.2% of residential construction companies said they were affected by project cancellations, according to a survey. That's the highest level since records began in 1991, surpassing the previous high of 21.4% in September. Business expectations in the sector have also plunged to the lowest level on record. The outlook for residential construction remains gloomy, and of course, companies are preparing for hard times, and that's what Citibank is doing. And of course, hard times mean people hit the unemployment line. Happens every time. And here's the evidence. Incoming orders have cooled noticeably as high interest rates and rising material costs intensify uncertainty among developers, and that means material costs are coming down. In October, 48.7% of building companies reported a lack of orders, of 46.6% in September. Lack of orders means, again, more unemployment. And with no recovery in sight, as we made the case, the situation is becoming a threat for some construction firms, with 1 in 10 companies already reporting financial difficulties. There's the evidence. The system is running out of money. Now, let's talk about Bank of America, because they have an outright shocking claim. This will bring complete panic to the U.S. markets and around the world. Let's take a look at what they're saying could happen. This coming from the Flow Show, the long end equals long leverage. But look at this, with so much anger, so much hate, yet unemployment so low. Can you imagine the social disorder if unemployment hits 5%? That's why policy panic, here you see their claim, comes in early 2024. And sure enough, I think B of A's got this right. But why would policy panic so much? Let's take a look at what usually central bankers are doing when unemployment rate rises. So here we have the unemployment rate in blue. On the red line is the 5% threshold, and overlaid in green is the federal funds rate. And notably what we see see here, going back to the 90s, the unemployment rate didn't get below 5%, but when it bounced off of that, what happened? The Fed was already cutting rates. And look here again at the dot-com bubble. When it broke the threshold of 5%, the Fed already cut almost halfway of where they were headed, or about a third of the way they were going. How about again in the global financial crisis? The Fed was a little early on this one, cutting rates about 20% ahead of when that threshold broke 5%. Now you hear them. What are the central banks telling us? Higher for longer, maybe even more hikes. And no, they're behind the curve, because when we see unemployment claims jump, and they're likely to, that means there's going to be a massive policy panic. Markets are going to get shocked. It normally never means higher equity prices. It means the global economy is crashing. And now we head over to South Korea. We have some evidence that perhaps their market is much closer to a big crash than anyone thinks. As short selling ban sparks biggest rally in Korean stocks since 2020, keep in mind this, ban is unusual in absence of a financial crisis. Of course, we know that's when policymakers ban short selling, telling us something is rotten under the South Korean economy. What the headline is saying is not necessarily means what the policymakers are telling us. The reason why suggests that perhaps some data is coming out from South Korea that says their economy is far worse than we thought. And if we hit that 5% threshold that Bank of America says, you're going to watch, there's going to be outright panic. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.